SentinelOne released their Q4 and full-year earnings for fiscal year 2025, and the numbers tell a compelling story about this AI cybersecurity powerhouse. Under the leadership of CEO Tomer Weingarten, the company delivered $225.5 million in Q4 revenue, representing solid 29% year-over-year growth. For the full fiscal year, they generated $821.5 million, up an impressive 32% from the previous year. This consistent growth demonstrates the strong market demand for their advanced AI-powered security solutions in an increasingly complex threat landscape. What makes this growth trajectory even more impressive is that they've achieved it during a period when many tech companies have struggled to maintain momentum in an uncertain economic environment. SentinelOne's ability to continue expanding at this pace speaks volumes about the mission-critical nature of their offerings and their success in capturing market share from legacy security providers. What's truly exciting about SentinelOne right now is their annual recurring revenue, ARR, reaching $920.1 million, up 27% year over year. This puts them on a clear trajectory to cross the significant $1 billion ARR milestone in the coming quarters, a pivotal achievement that often marks a SaaS company's transition into the big leagues. Their enterprise customer base continues to expand impressively, with customers generating ARR of $100,000 or more, increasing by 25% to 1,411. This metric is particularly important as it demonstrates SentinelOne's growing appeal to larger organizations with more complex security needs and higher spending power. Even more telling of their platform strategy's success is the 3x growth in enterprise customers using 3 or more solutions over the past 24 months, with over 50% of bookings now coming from non-endpoint solutions. This expansion beyond their core endpoint protection routes shows that customers are increasingly viewing SentinelOne as a comprehensive security platform rather than a point solution provider, which typically results in higher retention rates, larger contract values, and greater customer lifetime value. The most compelling part of SentinelOne's story isn't just growth, it's their dramatic move toward profitability. For the first time ever, they achieved a positive non-GAAP operating margin of 1% in Q4, a remarkable improvement from negative 9% in the same quarter last year. For the full year, they improved their non-GAAP operating margin from negative 19% to negative 3%, showing consistent progress in operational efficiency. They reported non-GAAP net income of $12.2 million in Q4 and $15.2 million for the full year, compared to losses of $6.6 million and $81.2 million in the prior periods. Perhaps most significantly, they generated positive free cash flow of $6.6 million for the full fiscal year, a dramatic turnaround from negative $83.6 million in the previous year. This inflection point in profitability metrics demonstrates that their business model is scaling effectively and validates their path to sustainable growth. The progression from high cash burn to positive cash generation is exactly the trajectory investors hope to see in high-growth SaaS companies, and SentinelOne is executing this transition masterfully. Diving deeper into their margin improvements, SentinelOne's gross margins have expanded significantly, reaching 79% on a non-GAAP basis for the full year, up from 77% in the previous year and 74% on a GAAP basis. This expansion in gross margins reflects the inherent scalability of their cloud-native architecture and their increasing operational efficiencies. As they continue to grow, these margins could expand further, providing additional leverage to improve bottom-line results. Their guidance for FY26 reinforces this trend, projecting non-GAAP gross margins between 78.5% and 79.5%, which are best-in-class figures for the cybersecurity sector. At the current price of around $18.51 per share and a market cap of $5.95 billion, SentinelOne looks significantly undervalued compared to peers in the cybersecurity space. Trading at approximately 7.2 times trailing sales and 5.9 times forward sales, they're valued at a fraction of competitors like CrowdStrike, around 20 times sales, or Palo Alto Networks, 13 times sales, despite showing strong growth and improving profitability. This valuation gap seems disconnected from their operational performance and future potential, creating what appears to be an attractive entry point for investors. The discrepancy becomes even more striking when considering that SentinelOne is now cash flow positive and has demonstrated a clear path to further margin improvements. Two critical factors that typically justify premium valuations in the software sector. Their technology leadership is evident through their continued position as a leader in MITRE AT&T evaluations for the fifth consecutive year, their 24 patents in AI security, and innovative solutions like Purple AI, their generative AI security analyst assistant. What sets SentinelOne apart technologically is their unified data platform, which integrates security data across endpoints, identities, cloud workloads, and other sources to provide comprehensive visibility and automated response capabilities. This approach not only improves security outcomes, but also reduces operational complexity for security teams, a significant value proposition in today's resource-constrained cybersecurity environment. Their continuous innovation in applying artificial intelligence to security challenges positions them at the intersection of two of the most powerful technology trends, AI and cybersecurity. With their total addressable market exceeding $100 billion across segments including generative AI security with $50 billion, cloud security with $31 billion, endpoint security with $17 billion, and data analytics with $12 billion, they have substantial room for continued expansion. The cybersecurity market continues to grow as digital transformation accelerates and threats become more sophisticated, creating a favorable backdrop for SentinelOne's growth aspirations. Their strategic positioning to capitalize on multiple high-growth segments within this expanding market enhances their long-term potential. Their recent acquisition of ZT Systems, a hyperscale solutions provider, further strengthens their data center AI capabilities, allowing them to deliver more comprehensive security solutions tailored to enterprise needs. Looking forward, SentinelOne's guidance for fiscal year 2026 includes reaching the milestone of $1 billion in revenue, projected $1.007 to $1.012 billion, and improving non-GAAP operating margins to 3 to 4%, continuing their trajectory toward increased profitability. This guidance suggests that management remains confident in their ability to balance growth with profitability improvement, a delicate balance that many high-growth tech companies struggle to achieve. With gross margins already at an impressive 79%, non-GAAP, there's significant operating leverage potential as they scale further. Their strong liquidity position with $1.1 billion in cash and investments provides ample financial flexibility for continued innovation and strategic growth initiatives, including potential acquisitions to expand their product portfolio or accelerate entry into adjacent markets. Another factor supporting SentinelOne's investment case is their FedRAMP High certification for both endpoint and AI SIEM solutions, positioning them well to capture a growing share of the lucrative government cybersecurity market. Government contracts typically offer stable, long-term revenue streams that can help smooth out fluctuations in commercial sectors. Their partnerships with major incident response providers and their risk-assuring initiative with value-added resellers, distributors, and managed service providers create additional go-to-market avenues that can accelerate customer acquisition without proportional increases in sales and marketing expenses. Of course, we must acknowledge some risks. Despite improvements, SentinelOne still reported a GAAP net loss of $288.4 million for fiscal year 2025, primarily primarily due to stock-based compensation expenses. While stock-based compensation is a non-cash expense, it does represent real dilution for shareholders and will need to moderate as the company matures. The cybersecurity market remains highly competitive, with well-funded rivals like Microsoft, CrowdStrike, and Palo Alto Networks pursuing similar strategies and often competing for the same customers. Additionally, their revenue growth rate is expected to moderate from 32% to about 23% in fiscal year 26, which could concern growth-focused investors who might be willing to pay premium multiples only for the highest growth rates. However, this deceleration is typical as companies scale, and the improvement in profitability metrics can often more than compensate for moderating top-line growth. Nevertheless, the fundamental improvements in SentinelOne's business model, their leadership in the rapidly growing AI security market, and their significantly discounted valuation relative to peers make a compelling case for investment at current levels. The combination of strong revenue growth, expanding margins, positive cash flow, and technological differentiation creates a powerful foundation for long-term value creation. As they continue executing on their platform strategy and improving operational efficiency, the gap between their current valuation and intrinsic value appears likely to narrow, offering an attractive entry point for investors with a medium to long-term horizon. And remember, this analysis is for informational purposes only and does not constitute financial advice. Always conduct your own research and consult with a financial advisor before making investment decisions. Hope you enjoyed. Leave a like and subscribe for more videos.